Yeah, so this has all been on the back of really the Trump tariff whiplash. Just no really plan set in motion or set plan. No one really knows what's going on. And day by change is over the weekend. It changed two or three times what was going to get tariffed in China, and we've just been seeing that over since Liberation Day, in quotations. I'm going to put that. But the bond market, which we want to focus on here, has just had the worst week in decades, with 10-year yields moving as much as 72 basis points. That's 0.72%, 100 basis points in the percent. The biggest increase in 10-year for the 10-year yield since 2001. The 30-year had its worst week since 1982. So decades long for a weekly change. Obviously, it's a small period of time, and it depends on longer term trends. But that is a shock to the market. And bond markets in general, especially the U.S. Treasury market or really any developed markets, so Canada, Europe, and so on, don't move quick. It is like a train. It takes a lot to change the direction it's going. So when it moves quick, it is very unusual, and it is not anywhere normally near this volatile. The U.S. has somewhere around $28.6 trillion in outstanding treasuries as it uses it to fund its ongoing deficits, which has had since the Clinton government and even before that, but that was the last time they ran a surplus. And that's funded by foreign governments, private investors, holding a large portion of that outstanding amount, as it's been the world's reserve currency since World War II, the Bretton Woods Agreement. So volatility like this in the US bond market is really not even just a worrying sign within the US, but globally, because it can really shift the structure in US or in global financial markets, not just in the US. Up here, I have the US yield curve, and this is just the shift between Trump's Liberation Day on April 2nd, and you can see the long and until last Friday, April 11th. And you can see the long end of the curve is noticeably steepened, with the short end remaining relatively the same, as that really just depends on whatever the interest rate is set by the central bank for whatever country it may be, in the US in this case. Trump does not want higher interest rates, with him continuously pressuring the Fed to lower interest rates aggressively. And further, and this is probably what shook him up last week and actually had a bit of a reverse course in his tariff policy. He even stated that markets were getting yippy when he announced that pull back to the 10% baseline tariffs on all but China, and that the bond market is tricky in the same speech. Take that as you will, but he's clearly, and his White House, his team behind him, is paying attention to the bond market, at least to some degree, and it's likely, in my opinion, influencing policy at this time. But still, overall, I will mention there's still higher tariffs than there is a month ago, just less than what we were initially going to see based on what I will just plainly say was poorly calculated tariff table that he showed on Liberation Day. Why does that shift in US yields matter so much? First, the US dollar as a whole, and by extension US treasuries, because that's how you'd want to hold your US dollars if you do need it. You want to get paid to hold your US dollars. It is the world's reserve currency, and has long been that safe haven asset when there's volatile markets. And we just haven't seen that over the past week, as the stock market has had absurdly high volatility, with VIX just spiking way up, and some of the biggest increases and decreases in the stock market that we've seen in years, if not decades, depending on what time scale you are using. Normally, a flight to the US dollar and treasuries occurred during any really market instability. People saw it as safe haven asset, but just the opposite has happened this time, which is extremely abnormal. We can see using DXY, which is the index over the dollar effectively. It's a basket of currencies that the US trades against, very heavily weighted towards the euro. It's like 56%, but then you got the Canadian dollar, the Australian dollar, and so on in it as well. But we can see the US dollar index has fallen sharply over the same time period. And as well up there, I have the Canadian dollar, and you can see the Canadian dollar strengthened during that time. DXY has fallen about 4% since April 2nd, which is a big move for currencies that are from a developed market like the US. This means there's been selling off of US dollars, not buying like you would normally see. So now, with higher yields in the bond market and a weaker US dollars, any entity with US denominated debt, whether US or internationally, will need to raise at a higher rate. Whether it's corporate debt, US mortgage, people who need to finance in general, just won't be happen if they need to raise in US dollars. International holders of the US debt, so on the other side of the coin, will be very unhappy, as they've seen their bond prices decrease, as well as exchange rate hurt them as well during this period, which can have some run-on financial effects. It's really a double whammy for anyone who is holding US bonds and their base currency is different. So if you're Canadian, European, and so on, you got hit by a double whammy there. And further, what I will mention here is it may impact companies, well, will likely impact companies who receive this is very common US dollars as revenue, but have costs in other currencies, which is common for things like commodities, but as many other industries, and just really depends on the company and where their end markets are. What that will happen is they'll have lower revenue and they'll have margin compression because their costs will stay roughly the same, but lower revenues. The magnitude of this change wasn't the largest, but the time period which it has occurred over is fast. So you'll likely just see headwinds, assuming things stay relatively similar going forward. But if you keep seeing the decline in the US dollar, that would specifically hurt companies which do have US denominated revenues and external costs or foreign currency costs from this perspective. Further, this will impact how we just look at assets trade against the US dollar in general. I want to just highlight this because last week we saw gold surge. It was making some headlines, gold being seen as a safe haven asset, but it wasn't, a large part of this wasn't just gold strengthening. It's because we measure gold against the US dollar weakening in this case, where the change in gold's price in other currencies just wasn't as big. I bring this up since if we do see a continued debasement or devaluation of the US dollar, we will see other prices rise in respect to the US dollar, but maybe not in other currencies, maybe not as much. The fluctuations will be different compared to the US dollar if the US dollar on its own keeps weakening. And since everything really that you look at indexes on international or commodities is based in the US dollar, you need to pay attention to that if you are not based in the US or use your US dollars primarily. So what is causing the yields to actually rise? Well, we know the initial push, the really trigger of it all was Trump's tariffs. That's obvious. That's not a surprise. But for bond prices to fall and yields to rise, someone needs to be selling. And that really has an array of speculation. I've seen all sorts of theories online. There's no clear smoking gun by any means. It's likely multiple things and multiple aspects going on at once. Because like I've said, there's $28.6 trillion in U.S. outstanding debt, with at least $8.5 trillion held by foreign entities. So that can be central banks, that can be private citizens. And that's only for the amounts actually held in US-based broker-dealers. So that's a minimum. There is more foreign exposure past here since you can't track it as easily. So the actual amount will be likely quite a bit higher. And naturally, central banks are major holders of US debt. So if they are selling, they're going to be selling a lot. They hold large amounts of it. And if they are selling, it would create massive pressure. And that's why people are really speculating. I've seen a whole wide array of speculation, a big one being Japan, which is the largest holder of US debt, to Canada, to China, to Europe. Effectively, any central bank which could have some reason, whether it's them wanting to weaken the US dollar in Canada's case or Japan case, because they're having this trade war to a degree. In China, it doesn't make as much sense, but I'm not going to get into that, why they would. But there's been speculation about central banks just selling in general. And really, this is due to how spread out the US dollar is we don't know what's causing it. I purposely left this pie graph up with all the different labels just to show how widespread the US dollar is for even major holdings for countries. And it's just completely widespread. That's why it is the world reserve currency, or it is the reserve currency because of that. And this is actually, I'm going to tie this into quickly the tariffs. This brief point is part of the reason the US dollar is the reserve currency is because they have this constant trade deficit. They are pushing US dollars out in the world to buy foreign goods. That's what that life cycle of a US dollar does to make it a reserve currency. A trade deficit has supported that aspect. But another popular speculation of why there's been this shift in yields has been deleveraging of basis trades, which are normally very highly leveraged, as it's just a very tiny little spread between futures and US bonds. Sometimes the futures are made into swaps, of course, which naturally converge over time. So as time goes on, the spread narrows, and then it's highly leveraged. So it might only be 5 basis points, but if you leverage up that 50 times, that's 2.5% over whatever time period it may be. And since the bond market is very volatile, it's harder to maintain that level of leverage. So some of the speculation is deleveraging just from high volatility. A couple other factors I've just seen brought up, just more general, is inflation expectations are higher, which does make sense when you see the long end of the curve go higher. That the length of the bond will be impacted more if inflation's higher over the long term. And investors want to be compensated for it. So the yield, real yield, so once you subtract the inflation, is similar to what it was before. And then just general deleveraging or hedge funds deleveraging any trades. The market was so volatile, you're going to have shorts get squeezed out, you're going to have longs squeezed out. Anyone with leverage could have got squeezed over the past week in reality if you were too leveraged, or it can just be general de-risking as well. And perhaps the most interesting long-term structural thing, which I will bring up, is just there's been more talk about just general loss in the US dollar as a safe haven. And really, is this shift in US yields and policy, the canary in the coal mines of sort for the end of US hegemony? Is that the case? If you asked most people a year ago, we were talking about BRICS. It wasn't really that big of a deal, but now more and more people are talking about that. Well, I don't believe that's the case this time. The fact that this is even being questioned on a broad scale, just not pure speculation type of thing, it does show that there's been really a global shift in perception about the US and US using the US dollar since the Trump tariff onslaught and its policy changes. If we do start to see continuous outflows from US assets, whether treasuries, but just the dollar in general, that would have a stronger indication of global structural change. We haven't seen that this time. It's been a week. That's a very short period of time for something like this. It would play over years, if not decades, for something like this. But obviously, that timescale could change very quickly, depending on the decision of one man, Donald Trump, over the coming days and months ahead. Anything could change with him. With some commentary being around some sort of Mar-a-Lago Accords to restructure finances similar to the Plaza Accords in 1985, which depreciated the US dollar to make them somewhat more competitive on the world stage. Are we going to see something like that? Generally, though, it will be something interesting to watch to see how the market continues to react, what will occur, and really, are we going to be looking back on this years to come? Is it going to be in textbooks, or is this just going to be a completely forgotten blip in the market like so many other things end up being? Yeah, I'll open up to you guys there.
Yeah, well done. I mean, and again, like that's then, just the thing is, we don't know what the smoking gun is. Even I was speaking with one of my friends, AJ, and he was, instantly Japan selling treasuries, Japan selling treasuries. And I said to him, I was like, as far as I know, that's a rumor.
That was the first one I saw as well, and I think it was one of the more popular ones.
If AJ says this, then I think we need to listen.
Yeah. Can we bring AJ on soon?
No, let's not bring AJ on. So,
oh, that's too bad.
But yeah,
AJ on, okay. So
it just is very interesting what's going on, and like Brett said, is this just a blip? Everybody's saying, oh no, the bond or the treasuries, aren't a safe haven asset anymore. It's been a week. Does it continue to be a safe haven asset over the next year? 2 years? We'll see. Is it just this little blip? Is it this basis trade being unwound by a lot of hedge funds and whatnot? Because again, typically you're buying treasuries, shorting the futures or treasury futures, and then if you're trying to unwind that trade, you got to sell treasuries. And again, like Brett was saying, you're just working with like just small little fractions, so you have to use a lot of leverage to make money or make a lot of money with these trades. So again, we'll see. It's very interesting, but I 100% agree that I think the bond yield increasing is influencing Donald Trump's policy. What did he say? The beautiful bond market, the beautiful bond market. He said something along those lines. I think it was the Thursday or the Wednesday when he put the 90 day pause there. But I know that everybody's saying, oh, he's not worrying about the stock market. Well, that might be the case. He certainly, has to worry about the bond market.
Yeah, I mean, we've talked about this before about how in the past when he's put tariffs forth, once he's felt a consequence, he's generally backed down off of them. And it seemed at first with the market going down or all the volatility in the market, like he was really digging his heels in and claiming that he didn't really care. But then when the bond market starts to falter, that's a whole different story. So it's wasn't necessarily what I was hearing people predict in terms of what would be the thing, but I mean it does make perfect sense given the size and importance of the bond market. I mean, if you just look at, as I said in the intro, it's very much kind of like the stock of the U.S. government, right? I mean, most of this is U.S. treasuries, and I think the figure that I've heard is roughly around 250 to 300 billion would be the annual increase on average for every 1% increase in interest rates would be the annual increase in the interest expense on US federal debt on average. Now, not all of this would roll over in year one, so it wouldn't necessarily be the year one expense, but that would be basically the average or what it would eventually transition into. So that's a major direct consideration of the US government that you can't just ignore, obviously, as it interferes with all of your other plans for how you're arranging your budget.
For sure. Yeah. And Brett touched on this, but it will be interesting to watch. It's an aside. Commodities like gold, they're priced in US dollars, for example. Like the US dollar continues to weaken. You kind of have to measure if it is a positive move in commodities in other currencies to really see how significant the move actually is, because everything's priced in US dollars, all commodities too. So, and it's interesting to just watch that. But definitely it looks like Donald is paying a little more attention to the bond rather than the stock market move. So we'll watch that going forward.